All right. Hello, everybody. Welcome back to another episode of Palantir Weekly. This is episode number 188. And this is going to be the final episode before Palantir ends out their 2024 earnings cycle for Q4 earnings that will be on Monday. Today was an exciting day for Palantir. We did hit an all-time high on the stock at $85.22 at one point. We ended the day at $82.49, pretty much where we were back in December before we had the 17% retracement to start off January. And we officially ended the month up about 10% or about 12% at $82.56 for the month of January. So we got a lot to talk about, a lot to get into going into our Q4 earnings preview. We got Matt Money with me on the show. We got Amir. We got Arnie, who's taken a little bit of a break. Arnie, what's up? How are you?
Yeah, 3 weeks and seems like so much time.
You want to tell everybody where you were and what you were doing?
Well, rather than staying in the cold and wear like multiple layers of clothes every day, I was just in Tenerife. It's a magical place where every part of the year you have at least I don't know what's the equivalent in the American degrees, but like more than 20 degrees, which means sun, beaches, and flip-flops.
Can you say beach again? Beaches.
I don't want to get Amit demonetized.
It's funny when an Italian talks about, I wanted to get away from the cold. I mean, come on, dude. Come to Sweden, I'll show you a real cold, dude.
You have no ideas how many Italians are escaping from the cold right now.
So Arnie, you also met some investors at the places you've been going to, and can you give us some insight on how they're thinking about Palantir right now?
Well, the week before, I've been to Switzerland. There is this event where I always like to go. Is a meeting of a very famous value investor. Not our traditional one. Is more already someone that is really in love with the concept of buying growth companies, but at a very good price with a very strong management. But even despite this condition, I find myself always a bit on the contrary side. And for years, like it has been like 4 years that I was talking about Palantir, has always been like, that's disgusting. Maybe then gradually, interesting idea, but SBC. Interesting idea, but nah. And now it's like, Arnie, yeah, but Palantir is so amazing. Like, oh yeah, but it's too expensive. I was like, okay, but now it's too expensive. Come on, it was at a value price before that, and you didn't want it.
So there's people coming up to you basically congratulating you about Palantir, but they can't get themselves to invest at these levels, essentially.
No, what I noticed is there is always a reason why people don't want to touch it. And before it was, it's it's too controversial. Then it is too complex. Then it's too SBC. Then but it's too expensive. And now it's like, it's definitely something I can't neither think of touching it, given the valuation. And as the valuation keeps rising, that makes you question, okay, but was it that expensive or it was just perceived as expensive?
Right. All right, well, let's get started with our earnings preview. We got a lot of numbers and charts to look at, but before we get into that, I want to go around the room and get everyone's thoughts on a new all-time high that we hit today, and also your kind of gut raw feelings about sentiment going into earnings. We'll start with you, Matt Money. Just raw thoughts as we get into earnings.
For sure. I think we've all been in the same boat for quite some time, just recognizing where we are in terms of price of sale, where we are in terms of net income, re-accelerating growth. And, it's going to be interesting to see how my article performs when it gets published, hopefully either tomorrow or maybe even Monday before earnings comes out. But it's not going to be well received by the retail community. I think a lot of the folks in the chat and many folks in Amit, unfortunately, it's going to seem like a hit on you, but hopefully, you take it with stride. A lot of people in the chat often are trying to ride a little bit of hopium as we go into earnings. And I think people need to recognize that the valuation is pretty stretched on this company. And as much as I love the company and I've been using the company over the past 7 or 8 years at my day job, valuations matter sometimes, right? And I think it's just at a point now where unless you truly get to a place where earnings growth is north of 30%, I think it's going to be pretty difficult to sustain the current valuation that we have. And keep in mind, I think a lot of people are expecting them to show up this quarter with 35, 40% sort of numbers in terms of top line revenue growth, but the company themselves guided for 27%. And so they're aiming for about $772 million, which I believe is where they'll probably end up. And I'm very curious to see how it performs if that's the case. We show up at 27% and we slow down from last quarter, which was 30% print.
Okay, Amir, your raw thoughts going into earnings?
Yeah, I mean, the expectations baked into the current quote are quite high. About 80 times price to sales, 416 times price to earnings. Even if you would do something instead of a pricing approach, but do a valuation approach, it implies something like 40% growth for 10 years and a 35% margin. So, I mean, there's a lot of expectations in the quote, but I'm not sure that's enough to like punish the stock price here. I think Palantir is in this tremendous momentum where even analysts are starting to come around. I mean, they are firing, demoting analysts that have been bearish on Palantir to like start to appease their customers that they've been telling like, no, don't buy Palantir. It's a sell from like $8 per share to 80. So, I mean, there's a lot of momentum in the stock. So I'm not even sure like what can send the stock down at this point. But from a, as Matt mentioned, if you take a realistic approach, then yeah, it's probably, there's not much that they can report to justify where it's currently trading. I mean, it would have to be something like 40% year over year, which I don't think will happen. So, I mean, there's a lot of good things operationally. I mean, all the risk in Palantir right now, it's in the stock quote. I mean, the operations are just phenomenal, keep improving. So most of the risk now is just in the stock quote.
All right, Andy, Arnie, your thoughts going into earnings?
It's always tough because we always need to distinguish what's the business, what's the stock. And I think it is really important to try to discriminate when we talk about these two components, because on the business side, I really struggle to find something that is not cool right now. It's literally the perfect kind of company that you want to invest in terms of business structure, like the resiliencies to shock. Actually, Palantir benefits from shocks. Recurring revenues, very strong free cash flow margin, now GAAP positive, growing, while also expanding margins. So operationally speaking, I really struggle to find anything that is not like perfect right now. Valuation-wise, that is another topic, but it's a topic that we have been discussing already for much time. And the reality is we keep getting humbled, even when we realize, okay, the price does incorporate very high expectation, and it's not like you don't need to be a genius to really see that, because when you try to inverse what is implied in the valuation, you realize, okay, 30% CAGR in the revenues for 10 years, 40% free cash flow margin. Numbers like that are already very high in terms of expectations. Almost no company in the world was able to sustain such a growth rate at scale. Neither the big tech actually were able to keep a 30% growth CAGR. But Palantir is a kind on its own, and right now is facing not a tailwind, is literally facing a tornado that is boosting their back. So when you have this condition, I think the playbook with which you need to consider stuff changes a little bit, because we enter in a situation where the perception can change the reality. Sounds so weird said like that, but if Palantir is really able to shape the narrative in such a strong way that is not only the leader, because we know right now is the leader, but is also perceived as the leader in this very strong growth market of AI, then a lot of adoption could actually arrive as a further effect from that condition, actually making Palantir not only the leader, but the perceived leader, becoming therefore the absolute dominant company in the sector. And the dynamic that I thought of it is Tesla during COVID. The fact that it was perceived as the leader in the EV adoption, and in that moment people wanted that specific thing, made Tesla the company where everybody was converging at, creating like a real effect in the numbers. Long story short, I think what really matters at this point, much more than the valuation per se, which we already know that is expensive, is how well the management is able to communicate the narrative into we are the company that provides value while everybody's speaking.
Yeah, I mean, it's just similar to what Tesla did the other day. I mean, the numbers weren't anything fantastic at all, but the stock actually went up, even though some would argue that Tesla, while not as extreme as Palantir maybe, but many would argue that Tesla was quite expensive where it was trading going into earnings. They miss on everything by billions, and Elon just sets the narrative during the earnings call, and stock went up for 2 days straight after that. So you're right, it's all about the communication. And as we all know, and probably the chat and people who watch us, is that this quarter, it's not so much about what they report as results today. It's more about what can we gauge about what's waiting in the future, because that's always been Alex Karp's approach. I mean, go back years when they ask him about operations, he's like, well, ask me in 2 years. 2 years later, stock price is at 80. It's always about the future with management and with Palantir. So all about the narrative.
And
go ahead, Arnie.
No, like just to break it down, but something we have been already discussing for more than a month. Like, what could be the weak point of everything is the SARS argument, which I personally would not spend too much time on. But what could be the final effect of this? Like, accounting-wise, we know that will have an impact. The question is, will the narrative that the company will try to share be more strong than this? Oh, this is just a little rock on the shoes, but let's remove it.
Yeah, I would agree. I would agree with all three of what you guys said. I think obviously guidance is going to be very important. Street's probably looking for at least 30%. They guided for 27%. So really what they're going to come up with versus what they guide for 2025, I think that's going to determine the trajectory of the stock. And then obviously SARS, I think no one really knows exactly what's going to happen with that. So that'll also be something we have to see on Monday. Let's get into some numbers. I know we have a bunch of charts and different metrics we want to get into. Amir, you can share your charts. Matt, I'm going to start with you. I see you shared some charts right here. I'll give you the floor, and you can kind of take us to any direction, and then we'll keep going from there.
For sure. Yeah, I just wanted to kind of give people some context with respect to what they are guiding for, because I think a lot of people are coming up with numbers in their head. And so what I had done is just taking the opportunity to create some charts, trying to be more like Amir every single day, right? So what I basically had done, and you can kind of see the hollow or transparent or translucent sort of valuations in here, where they're kind of guiding for in terms of net income. And some of this is my personal kind of adjustments, but hopefully we can get an idea. So the 772, that's the 27% revenue growth that you're kind of hearing from Palantir in terms of guidance. So you can see that is a tick down from where we were last quarter. In the third quarter, we printed a 30%, and that obviously was met with a lot of optimism. The stock going from the 60s all the way to the 80s at this point. So the stock rallied very heavily on that. And so with that, we would end up at about a $2,810,000,000 trailing 12 month or fiscal year 2024. And with that, you end up, I guess, slightly in the 26, 27% year over year sort of growth rate. Keeping in mind you were at 21% in the first quarter, 27 in the second, 30 in the third, and then if you get to 27% in the fourth, you end up in the kind of mid to slightly high 20th percentile. And with that, you can end up with about 4.8 billion in cash. I don't necessarily have too much. This is kind of an estimate, 674 in terms of customer count. I kept share-based compensation. I didn't necessarily know what to think based off the SARs, etc. But just wanted to share this in case we need to reference it at all through the conversation today, where we're at. And I think one thing that was very interesting that I wanted to kind of keep track of is with respect to buybacks. I kind of started a buybacks over share-based compensation in terms of dollar amount purchased. It's actually very interesting. So we purchased about $1.8 billion worth of shares, but at the same time, if you actually look at the amount of repurchases compared to the actual share count, we've over the past, say, 12 months, we've given out about 130 million shares total. And even though we've spent, close to 45 or 50 million dollars, we've only repurchased about 1.8. So it just goes to show the shares that these people are getting are very cheap shares, obviously due to the fact that the price has expanded rather rapidly. But I'm also very curious to see where net income shows up. Gross margins, I'm anticipating everything's going to be okay there. But yeah, I just wanted to kind of get into the room and share, because I think a lot of people are saying, hey, we should be expecting 35, 40%, but that's not what Palantir guided for. So I just want to get people back grounded in reality, and it very much well could show up as 35, 40%, but that is not what Palantir guided for.
Yep, that is a fair point. Amir, you can load up your charts right now in the back as well. And I think I'll let you figure out what we get started with, but I think either revenue growth or customer count might be the first one that I believe you want to get started with.
Yeah, sure. So similarly to Matt, it's nice to get everything visualized because it puts things into perspective. So should we talk like point by point as we go and discuss around it, or should we? Do you want me to just present stuff, or?
No, I think let's pick one metric and then we'll pick one metric and go around the horn. So this is what we'll start revenue growth and we'll get everyone's take on it. So.
Yeah, I hope this shows up well on stream. I know StreamYard like compresses quality, so it's kind of bad, but here's zoomed in. So my estimates are around that 800 mark, which would be a slight increase year over year. But keep in mind that Q4 of 2023 is a much stronger comp year compared to the 3 previous quarters. So hitting that 31% will be a lot more difficult compared to in Q3. But I think just for the stock quote, anything like that is a slowdown compared to the previous quarter, it would really be bad for the stock if I had to guess. So I estimate something like around that 800 million mark, because we just need to see some sort of increase if we're going to have some hope of staying around that $80 mark and keep the momentum going, at least narrative wise. So I'm curious to hear what you guys have to say about your expected revenue growth.
Can I ask a clarification question, Amir? Are you hoping that it gets to 800 because you want the stock to stay positive, or you want it to be 800 because that's what you think?
No, it's my actual estimate.
Okay. Yeah, I'll chime in here. So I did some quick look at 800 million. You're at about 10% quarter over quarter growth, and we haven't seen that since 2021. The last time we had seen anything close to a 10% quarter over quarter was 9%, and I believe that might have been, let me double check my numbers here. I think it was 3Q of 23, fourth quarter of 2023, and everything else has been a print of about 4, 7, 6% in 4Q of 2022. But yeah, the last time we had a 10% quarter over quarter was the fourth quarter of 2021. So I believe that would be I'm not saying you're wrong, and I hope for the best and for the underlying company to meet that sort of expectation, but we'll find it very surprising if that shows up.
Let me chime in here, Matt. Do you think, given Karp is touting all this stuff about demand, especially today on CNBC, he said we have just so much demand, we can't handle it. Do you think if they don't show 10% growth quarter over quarter, then all this demand stuff is not real that he's talking about?
I don't think it's not real. I mean, they are growing quickly to an extent. I mean, if you think about it, he's been saying kind of the same sort of discussion since 2023, 2024, since they released AIP. And, we've seen 7% quarter over quarter prints for the past 3 quarters in a row. And I anticipate we'll see a 7 to 8% print come here on Monday. But 10%, that's huge, right? I mean, that's 75 million increase in a single quarter. And if you take into account what we saw in the previous quarter, that was 17%. That's 18% growth within 2 quarters. That's pretty expansive.
I think the reasoning here is there's a lot of pull forward from the bootcamp, because if we look, let me just change chart really quickly. One of the most disappointing things that we've had is, just as Amit mentioned, the net addition of customers. And if we look at the quarter over quarter growth, it's really been decelerating, even though we got that initial. So this is quarter over quarter, this yellow bar. No, actually it's year over year. Let me see if I can get the US commercial one then. Yeah, here we go, the quarter over quarter. So
yeah.
The thing that we were discussing is that, well, they have all these boot camps, but even though we got that initial push up as of Q4 last year, which is like when just bootcamp started ramping, I think they did around 300 in Q4, then 600 Q1, 1200 in Q2. So it's really been exponentially increasing, but that's not really translated into, I know it says dollar here, ignore that. It's not really translated into that customer growth that we were expecting. We've actually been seeing this deceleration. So I really expect that we will have a pull forward on that, or like a what's called like a catch up, because many of the customers, like it takes time. Even though you attend a bootcamp, it's not like you sign up then and there. There could be a pilot, you have to convince the C-suite and stuff like that. So a lot of it. So even though, as you mentioned, on a quarter over quarter basis, it might sound like very optimistic, but keep in mind, like, I have a very optimistic view of Palantir's future, and I believe that this quarter in particular, at least the year that we're heading into, will be very pivotal, because if we listen to the UBS report, there's a lot of scale. So let me just change a chart quickly just to make the point why I believe 31 is reasonable. So if we go to the cohort growth, which shows us net dollar retention, which is growth from existing customers, we've seen that that's really been exponentially growing as a result of AIP scaling. So many of the prior quarters, AIP spending was really limited, as Carp said, like, yeah, we don't have a pricing strategy for AIP. However, the UBS report showed us that they do indeed have one. And as these customers start to scale up, we'll get a lot of growth from the current customer base. That's why customers are really important, right? We always talk about, as long as we can get through the door, we can show that Palantir is valuable to the business. And the customers, like, one, it will be sticky, but also we have this opportunity to scale up current customers, which is what I believe will continue to happen. So we had this low of 107% net dollar retention. Then we just keep going up. So for Q4, I have it going from 18 to 20. So a lot of that growth, I mean, from new customers, I have it actually decreasing from 12 to 11% year over year. Most of that growth in my 31% is actually from current existing customers. And when you have a larger existing customer base, it's easier to scale the revenue within them. And that's what we've been seeing proof of. So this 31% is actually not that extreme if you consider that most of it is going to come from, like, 2/3 basically are coming from existing customers. So that's my reasoning around the 31%.
I want to hear Arnie's thought, but I did want to ask a question, because you probably have this and I don't. Do you have the graphic of international revenue growth?
Yes, and it's not pretty.
And I want to know if that's the reason why we're seeing such a drag on new customer / existing customer.
So
and then I want to hear Arnie's
non-US commercial, and it's not a pretty sight. I mean, we have 3 quarters in a row, quarter over quarter, where we have actually been negative. So negative 3% in Q1, 0% growth in Q2, and negative 7% in Q3. So this is a huge drag on revenues.
And just potentially lost Ferrari too, right? So interesting. I need to add this. This is really good. Thank you.
Yeah, go ahead, Arnie. Yeah, go ahead.
Yeah, I was gonna say, Arnie, your thoughts on if Amir's number of 30% growth, 799 million, do you think that that's possible?
I think is absolutely possible, and I'm mute. Okay, I think it is absolutely possible, but I would underscore also that is a little bit of needed for the narrative to keep rolling in favor of the company. This 30% is really psychological because it's already is what defines a fast grower company into this is a high growth company. So the focus will be on that. Now, as Emira mentioned that the guidance is 27%, and if you notice, typically the discrepancy between the guidance and the actual results is always like a 2-3%, and in the last quarters we were talking about like 5% surprise, which is something that made the stock pop. Now, it is true that so there are many dynamics in play. So we could say, okay, what's bad, what's good. Let's start from what's bad that could go against these numbers. We know we know US commercial is the driving force that is growing so fast, and in these quarters, it seems also the US government side is really pushing. So there is a very positive push that both attracts new customers and make the existing customers expand. We were wrong into thinking that Palantir would have started being very focused into expanding the user base, but in reality, they were more focused into expanding the depth of the existing customers. And maybe that is something that they keep doing so that they acquire new customers without the real needing to convince them, because they're already convinced. They just want to get the same product that their competitors are using, and we also want that. So that is very positive. But, and we know that the AI narrative is as strong as ever been. Palantir now has very strong reputation, so everything converges into having very strong numbers. Now, what could go against that could make the results a little bit in line with the guidance and makes it harder to reach these 30% is the international side, as Matt wanted to underscore, because even Karp itself, from the last interview that I think we'll touch later, he said, okay, US, that's perfect, but Europe, I think Europe that don't want to spend in AI wants to stay behind. That to me gave me a sense of, okay, on one side, everything is going even too strong. On the other side, very aware that there are some friction. I would say the real effect then will be into how they're able to shape the narrative as well. But this is something I wanted to really underscore. In the last quarters, Palantir got results that were 5%, 4% better in terms of their revenue guidance. And in terms of margin, that was like 4%, 5%, 3%, and again. So after having started their period as a listed company with very, very strong guidance and very strong expectation, and then failing to deliver, now we're seeing Palantir doing the opposite, being very good at managing expectations. And when they drop the guidance, they already know essentially what they would almost close the quarter with. So I think if they delivered the 27% guidance, I think it's because they expect like 29-30% revenue growth. Now, personally, I don't care if it is 29 or 30. Psychologically, I think the market cares because they want to see this 30%.
Do you think 30% is sufficient?
For what?
To maintain the $80 to $85 stock price?
Potentially, yes. Because if it is a 30% and there are signals that this could be not only sustained, but can keep improving, I would say, why not? And don't forget that now we like to focus into the revenue side, which is obviously the key driver, but where the biggest surprise has arrived so far was on the margin side. And there, what struck my attention was, yes, 27% revenue guidance. That's the biggest guidance they've ever said. So probably if they dropped a 27, that's why I think 30 is absolutely reasonable that they expect that to be achieved. But in terms of margins, like typically they were guiding something like 30. In the last quarter, they said 34. They delivered 39. And now they guided for 39, which is a very, very strong number to say in a guidance, which makes me think, what if it will be like 42? And if we combine that with the revenue growth of maybe 30, maybe we can even exceed the famous rule of 40 with a number of 70. And now we are at 68, which is already an absurd number, like the biggest, the best number in the entire SaaS market. So my personal expectation is that we will get to the rule of 70 with like 30% guidance and 41% free cash flow margin. That's my personal expectation.
Those balloons means we're going to 100, bro. Those balloons.
Steve's 125 price is in action.
I mean, can we talk also about, because we talk about, well, you don't have to share this chart yet. We will get there. About revenue still, like top line. One of the, okay, so we know that management typically guides pretty low compared to what they deliver. As you mentioned, the prior quarters, I mean, we're talking like 3 to 5% typically above what management guides. The problem I see is that analysts guide are super low as well. I mean, we see these forward pricing metrics thrown around, like forward price to sales, forward EPS, and they are also like not getting it at all. So do you believe that we will start to see actual estimates from analysts on Wall Street that will be difficult to beat? Because I mean, it's been like 3 beats so far this year. Like when are they going to catch up and see the actual narrative? And not maybe only narrative, when are they going to start expect more from Palantir? Because it's no longer the case that like the average price target is like in the 20s. Like we've got an even bearish analysts like expect 60. Many are expecting more than 60. Some are like 80. We have now Danais at 90. I mean, aren't the estimates going to start to follow? Because even Danais revenue estimates are like super low. Like we're talking like 27% revenue growth, like something super, super low. Like the consensus estimates for revenue are very low compared to what they're delivering, 1, and 2, what's expected in the stock quote. So what do you guys think about when will analysts start to catch up and actually start to put Palantir under pressure in terms of their revenue estimates?
Arnie, you want to take it?
I personally think analysts will face the pressure of their own estimates for a simple reason. If you see this chart with the analyst expectations for the revenue, we can dig deeper into what are the consensus numbers implied in the evaluations from analysts. And they essentially expect this quarter to be strong at 30% growth, then to have a 30% growth for the first quarter and the second quarter of 2025. But since that, they already expect the revenue to start decelerating to 27 and then 21% for the final quarter. So the end result is that analysts overall expect a revenue growth for the fiscal year 2025 of 26%, then to decrease to 23% for 2026. If I look at these numbers, I would say yes. I mean, we can say that they are trash numbers because growing those numbers at scale naturally would get some frictions, but that makes me think that analysts are not really thinking in terms of network effects that could be triggering once you have this tornado of very good conditions just bombing the company. Now, every company now realizes that they need to invest in AI, but very strongly. Right now, companies realize that is not a fancy item, is a matter of survival. And you see evidence that companies that are really embracing these components of AI are delivering better growth, better margins, and so on. So now Palantir is literally the name that is recognized as capturing the entire value, and the recent saga with DeepSeek and so on actually validates the value proposition that Palantir is having. So I'm noticing a shift in the narrative also from media that points to, oh, but we were so focused into LLMs, but what if the real value actually is in the application layer? Even Cathy Wood realized that, even if I was expecting her to be more voicey for time now, like even her now, she says, okay, all the value is in the application. And if we need to be honest, these numbers don't really, like these 26, 24% and expected numbers from analysts don't really fit with the narrative that Palantir is becoming the operating layer, the operating system for AI, the key software platform that enables companies to deploy AI, is just good growth. So that's why where I see a bit of discrepancy from what we that are very deep into the company and what analysts perceive overall.
And if we tie it back to what people care about, like the effect on stock price, right? Like we've had pretty easy setups to deliver beats. Now, while net income will be, I mean, EPS will be difficult, and net income for this quarter, I mean, still the revenue beats will continue to come because they're just too low. So it's not been hard to sustain the momentum when you keep beating and beating and beating by, like, typically people look like, what's the percentage beat? People don't actually look like, okay, what did they actually deliver? And the general public don't really compare like we do quarter over quarter or year over year. They just look, did they beat or not? They don't really care what that beat implies. So they've been really making it easy for Palantir to sustain the momentum, I believe.
Sorry, just a little thing. This is the last quarter, so we're talking about Q4 numbers, and they will drop the guidance for 2025. So we are now talking a lot about the quarter, but in reality, everything will converge to that number. And that could be the discriminant from a quarter that is okay in terms of operations, but what will, at the end of the day, move the stock price and the narrative is how strong the narrative is, because everybody is seeing these cloud providers spending 50, 80 billions. But okay, what is happening on the software side, and the guidance that Palantir will share, especially now that is recognized as the AI leader in AI infrastructure, will set the tone for how asset managers think in terms of where the value is accruing into this next year.
Yep.
Go ahead, Matt. Go ahead. You got it.
I was just going to say, I mean, I think I wanted to transition it to 2025, and
I was going to go there too. Yeah, I was going to go there.
Very good. So I think, you know, and you guys can read more about this when the article comes out, but no matter how you describe it, 2024 perspective, you could kind of say it's overvalued, right? But let's just give some grace and say, okay, 2025 is going to be different. So let's just say we do actually get to 4 billion, right? Which is a 40% year-over-year growth from about what we're expecting to see, whether it's 27, 30% in the fourth quarter. You know, give us some grace. Fiscal year 2025, we get to 4 billion, right? Which is way more than the 26% that analysts are providing, but let's just give us some grace and say that. Even still, price to sales will be between 47 and 55 times if you're between 3.5 and 4 billion in terms of revenue. And that's still way north of a typical 9 to 11 times that are expected in kind of software sales that, you know, you're seeing in the majority of the S&P 500. So there's that number, 45 to 50x in terms of price to sales, still very richly valued. And then also on top of that 4 billion, let's assume we get net income margins of 5%. That's 5%, sorry, 25%. That's 5% more than we're kind of seeing right now, at 20% currently. And that's likely to be very high on the upper edge of Palantir's guidance, if at all. But let's just say you do get to that. Your price to earnings is still going to be just below 200x compared to where it is today, which is still pretty aggressive, which is an improvement on fiscal year 2024, but way overvalued, if you ask me, compared to current growth. And in this generous forecast, I just want to give some other ideas for other ways to evaluate this. I've been on a price to ops cash, which generally is much higher than the net income due to the drag of share-based compensation. You're still looking at 135x price to ops cash, and that's assuming a 35% ops cash margin. So, I mean, the what I'm getting after is, even if you're looking at 2025, and even if you were to add numbers onto 2026, how many years are you willing to pay for what you're seeing today, right? And what if sentiment on the stock changes back to where it was back in 2022? We've seen this, and already I think, and Amir mentioned this, back in 2022, 2023, the sentiment on the stock was dog shit, to use a horrible word, but it's the truth. And so, now that we're in this hopium stage, which is what I'm kind of calling it, is retail really willing to hold 80s on the price tag if these numbers kind of come to fruition, and yet the growth doesn't grow into the 40s, 50s, 60% year over year kind of.
Yeah, I think one thing that's really important about this is that what you said, Matt, is that even if we have an incredible quarter, like 40% growth, which I don't know if we're going to guide for that, but let's say we guide for that, still the stock is expensive, right? It's almost 5 times the normal price of sales for a software company. So I guess that begs the question then, do any of us think this stock is ever going to trade back down to what people would consider reality? Because let's say we don't get a 40% guide, which I'm skeptical, because if they were going to do 40%, I think they would guide for like 32% and then just slowly raise it. They wouldn't give it all at once. I mean, at this point, Palantir's defied reality for the better part of the last year. Do we think it has to come back down to reality, Arnie?
What's the reality?
Well, reality would be, I don't know, 20 times price to sales instead of 72, right? But like so I guess the question is the qualitative, when you hear OpenAI getting a $350 billion valuation, is that so much in the news that it would make investors overlook the 72 times price of sales that maybe becomes 50 times, as Matt was saying, with 40% growth, and still say Palantir is the answer?
I'll tell you paradoxically that I think 20 times sales right now would not be reality. That would be insanely cheap. That's my personal expectation at that time, because if you think of 20 times sales, which is already the double of the average software company, if you look at it from a free cash flow perspective, you would get a company that has 30% growth, 40% free cash flow margin at 60 times free cash flow. Actually more, 60, but less than 60 times free cash flow multiple.
Yeah, right now it's at 140 times free cash flow.
Well, that's right now is very high, okay, but it's very high also based on relatively weak expectations. That's why I keep insisting that when we look at the multiples based on the future, we need to check, okay, the multiple is high or low, but we also need to see how high or low the estimates with which that multiple is computed. And we noticed just a couple of minutes ago that the analyst expectations for that future are not that high. And that is essentially why the bulls have won us up to now, because even when people were saying, oh, but okay, now let's say that SBC is not a problem, the stock is still untouchable from a valuation perspective, but the numbers came out much better than the expectations, which essentially made the real numbers shrunk every time. Now, you mentioned OpenAI, that literally poses the question, but is Palantir less valuable than OpenAI? Frankly, I'm surprised that just a week after seeing the potential thesis of OpenAI shaking a little bit with DeepSeek, which is essentially a Chinese chip clone. You get OpenAI having talks about more than doubling their reputation. I remember the last time was 150, so more than doubling, while they're still burning a lot of cash. There are essentially no expectations, while also the entire thesis around the company is starting to shaking because if your product is more and more commoditized, you have less pricing power for the revenue, which also means getting to profitability is way harder. On the other side, you have a company that is already like perfectly sit. In 5 years from now, we argued that the value is more converging into the application layer, while the competition is fierce into the AI model layer. So that makes me question, okay, the valuation of Palantir is high, is very high based on multiples that reflect relatively pessimistic expectations versus my own expectations. And on the other side, we see the market that is willing to pay $350 billion for something that is set to be commoditized. If I look at it in that perspective, I would say, yes, if I stay in the spreadsheet, it makes no sense. If I look at it in an overall context, I could see a sense for which, okay, now all the money starts converging again into Palantir because that is where people realize the strong value is. I don't see absurdity into thinking that we could keep going higher and higher, because look, that's a little like a random like boom. Costco is trading how much at 50, 60 times earnings for a company that is growing well, very well compared with the peers. But overall, that is not a company that can scale almost infinitely like Palantir. And Palantir can literally take all this $1 trillion TAM that Karp was mentioning time ago. So yes, there's a comment that Costco is reliable, and will say Palantir even makes more money if there is a world war. Whatever problem there is in the world, potentially you can solve it with software. And now Palantir is perceived to be that kind of software that can solve literally almost every problem.
Yeah, essentially making the argument that in this market, if we're trading at 60 times earnings on Costco, which, you know, there's not the biggest
pay that, to be honest.
Yeah, the fact that investors are willing to pay 60 times on Costco for relatively small growth compared to something like a Tesla or Palantir or whatever, maybe not Tesla, but an Nvidia or whatever, then that means that the market would be willing to pay a premium on a company that has all the brand recognition like Palantir does, even if the growth is not astronomical like Nvidia. Amir, what is your perspective on Palantir price coming back down to reality, and what do you think reality looks like for Palantir?
Yeah, just quickly, I think pricing metrics are a very flat way to look at things that don't really capture the drivers of intrinsic value, which are growth, cash flows, and risk. I mean, it's just a reflection of current or near-term expectations based on analysts, and in Palantir's case, they've been very wrong historically. I think looking at pricing metrics and relating those is a lot more of a more proper approach for more mature businesses. I mean, for Palantir, that has most of its value and growth like into the future, even in the terminal periods. I mean, Palantir is the type of business that benefits greatly, as Arnie mentioned, from network effects. The core mission is literally to be the operating system of the modern enterprise. Basically, every single industry that exists, both in the commercial and government space. So it could be anything: military, healthcare, aviation, logistics, energy. I mean, literally, there's nothing that Palantir can't do. So trying to base like, well, based on current revenues, it deserves this kind of multiple. That's not the way I approach it. I like to approach it from actually a valuation perspective, where we look and try to estimate future performance and bring it back. And yeah, to answer the question, yes, I do believe it is both overvalued and overpriced here. If it gets back to reality, I mean, it always does sooner or later. For Palantir, the current narrative that I can tell brings us something like, let me just check, like $53 roughly as of right now. Of course, that's keep changing as we learn more about the business. But yeah, I believe it is very possible that it will come down to somewhere in the 60s, 50s, perhaps even 40s, depending on the external factors. Like we know that the 47th president is doing a lot of stuff. It could weigh down on the market, like external factors. But that doesn't mean the business is weak and it can't grow at 40% that we've been talking about. It's just like the current valuation for the narrative that I can tell. So can it? Of course. It's always easier after the fact. People will tell you, oh, I knew it was a bubble, that it will pop. And then as it keeps trading up, people will be like, yeah, you just don't get it. So you always get two sides of the coins. You get the overly optimistic and overly bearish, depending on where the stock quote is. And reality is usually somewhere between. And for me, that's somewhere around $55 to $60 range. And do I believe it can get there? Yeah, sure.
Mm-hmm.
Do you think?
At what point do you think that we can stop saying that this company is early on in its profitability journey? I'm not trying to be mean or trying to call anybody out here, but we're 30 months in, right? This will be the 10th quarter of net income profitability, and we've been adding cash to the balance sheet based on the fact that we have positive ops cash for the last 48 months. So at what point which is 4 years, right? So at what point do you say, okay, it isn't necessarily a young growth company anymore? You need to start valuing it kind of like how you're evaluating Google and Amazon and things of the like, when valuations matter more so for those companies. Granted, yes, they're on a much slower year-over-year revenue growth. They're anywhere between 15 to 20%. Some of them are in between 10 to 15%. But at the same time, I don't think that you can just say that valuations don't matter in some sort of respect. I think we're getting to a place now where the grace period is it's kind of been given, and we're getting to a place where the company is kind of getting to a place where it's maturing. Net income is getting closer to the ops cash margin, etc. So things should start to align more so than diverge.
I never said that valuation doesn't matter. I said that I never look at pricing.
I'm not calling you out specifically, Amir. I'm just saying in general, for everybody.
So my approach to this is that we are currently 2023 $2.2 billion of revenue. This is for a business that has basically infinite TAM. I mean, I personally, by 2034, I have them doing closer to 40 billion from that 2.2 billion base from last year. So in that regard, you can't really say that this is a mature business. I mean, profitability wise, if we're looking at actual cash generation, I mean, they are very profitable and have been on a free cash flow basis, even to the firm, or if you do the traditional approach. I mean, we are around that 30% mark, so they are generating a lot of cash. But it's still like, what makes it mature or not is how much more scale there is to this business. And for Palantir, at currently 2 billion, they are just starting to scale up. Like we have 600 and some customers from a base that is basically worldwide, global, not counting.
Can we pull up that chart, Amir? Customer count. We could transition to that because that's a good conversation too.
Yeah, but also, sure. Touching on that, I mean, even if you do think you get to 40 billion and you get to a 35% net income margin, we're still at a price to earnings of 15x. Yeah, and that's all the way out, and when you get to a revenue of 40 billion.
That's like in 2033, right, or beyond that.
Here we go. This chart.
Yeah. Basically, Amir, your point is that we are so early in our customer count journey that you think that can grow. And to Palantir's credit, I mean, they've publicly said they barely have any customers at 600, and they believe they can have tens of thousands of customers one day. So your argument is the TAM plus the customer count growth makes it early right now.
No, what I'm saying is that a pricing approach doesn't really make sense at an early stage of a business to me. Well,
yeah, but
to me
Matt's,
personally,
Matt's question is, why are we an early stage business? And my interpretation of your response is that because we barely have any customers. Is that correct?
No, because we are barely in the early innings of scaling up to what this business can be. I mean, when you are in the conversations of talking about a really mature business like Coca-Cola, I mean, okay, how much more bottles can they actually start to ship daily? I mean, there's a cap to that. I mean, that's a mature business. You won't expect a lot of growth. Sure, they will be profitable. They will reward shareholders. But there, you can actually make a multiple approach where you start to look at, okay, what's the price to sales and PE that's worth? Because that business is not really like, as Aswat Damodran likes to say, he makes this argument with chapters of a book. I mean, it's at chapter 33 of 35 for Coca-Cola. Like, the story has already been told. They already use third-party bottlers to raise their profits, and they already scaled globally. They're available in every country. There's just not much more that Coca-Cola can do. For Palantir, we're like at chapter 5 of 35. I mean, this story can still go every which way. So in that sense, it's still a very young company. And even though we might have these expectations for the business, that's only a reflection of what we understand today. And as anyone can tell you about Palantir, go back 2 years before AIP was around. The story that we could tell was completely different. And who knows what this looks like in 2 years? I mean, this is still very early in Palantir's story. So in that sense, it's still a very young business, even though it's been around for 20 plus years, even though they've been publicly traded for since 2020, stuff like that. I mean, it doesn't mean that it's a mature business just based on how many years they've actually been operational, profitable, or growing, because there's still so much untapped, is the argument I made.
Arnie, your thoughts?
Well, while the principal Matt is sharing that Palantir is maturing, and based on the maturity level, you try to have a different approach, I also disagree with that we are actually at a mature stage because, or even remotely close to the mature stage. Even the numbers are already very, very pretty for a simple reason. What's the connection with Coca-Cola? Coca-Cola almost saturated the entire market that it could potentially saturate, and getting that marginal customer becomes harder and harder. While with Palantir, it is actually the opposite. The marginal customer is easier to acquire, and the potential scale that it could eat is enormous compared with the cake that is currently eating. We are talking about how much? Probably like 1% of the entire market. Like we said, the TAM is expected to be like 1 trillion for the AI software market. And we are at a couple of $1 billion revenue. So that gives us a sense of how big the opportunity is. Now, obviously, it is impossible to capture the entire market, but it is possible, Apple-wise, Tesla-wise, to capture the entire value, the entire profit of that market. And personally, I think we are such at a very early stage with that. And the number of customers just speaks for itself. Now, right now, I think Palantir has like a seed in almost all the industries, but we are talking about a couple of layers for each industry compared with the total number of customers that could be achieved within those industries. And even with the leaders, even with these companies that we are talking, we are more familiar with, just something that keeps coming to my mind is the average revenue Palantir is getting from its customers is around 5 million. Correct me if I'm wrong. But there are customers that have been paying Palantir for like $10 million per year, which gives us a sense how much potentially these customers can keep improving, can keep expand. And the interesting thing is not that these very big, well, we know the top 3 are in the range of $100 million per year. The top 20 are more in the range of $50 million per year. They're not slowing down. Like, they keep spending more and more and more and more. That, to me, is an early sign of how early we are.
Mm-hmm. I know, Amir, you probably have some really good points, and I just want to say I agree with both of you immensely. Right, I am a Palantir bull. I believe that this will eventually be a $500 billion plus, if not $1 trillion company. But just taking a step back, Palantir is currently the 48th largest company on the S&P 500, and they're ranked amongst the folks of Pepsi, Disney, Caterpillar, Texas Instruments, BlackRock, Goldman Sachs, other very mature, not other very mature, but mature businesses, right? So at the point that we're trying to make is we are currently being valued as a very mature business. And going back to Amir's point, at $40 billion, 35% in income, you're still at a 15 price to earnings multiple like that. That's a mature sort of valuation. Now, do I see us eventually getting to the 500 billion, top 20-ish sort of companies where you're starting to get to $500 billion plus? I do. But what I'm just saying is a lot of that value has been recognized, and it's going to take a long time to really get to a place where those valuations make sense. And yes, the net income margins might be better. The overall company and the need for it in terms of how its importance of American society might be there. But what I'm trying to say is easy money in this respect has been kind of made, and whether there's a pullback or not, I don't know. I can't predict anything. It's just my thoughts. But at the same time, I'm just trying to recognize where the companies that it's stacking up against within the S&P 500 are in terms of their maturity. And then you have this brand new company as you're. I'm not trying to be mean when I say this, but in terms of what you're saying, comparatively mature wise, a newer company like Palantir being ranked amongst these folks, it is kind of a sore thumb, right? And that's what I'm trying to point out, right?
I think it's the nuance of being a Palantir investor right now, because everything Amir and Arnie is saying is 1000% correct of how early we are in the journey. But everything Matt is saying is also correct of but we're valued like we're Disney or Pepsi. And it's very difficult to kind of resolve the fact that this is a $200 billion company that is just beginning, literally, they're in the infancy of their growth stage, but the market has already recognized so much of that value for whatever other qualitative reason, because it's not quantitative since the growth hasn't been there to justify $200 billion. And it's given us this valuation. So the question then becomes, can they have more growth to expand from 200 billion? Can they have enough growth to stay stable at 200 billion? Or do they not have the growth and we go back down substantially to then eventually get back to 200 billion? And I guess Monday's going to let us know how this plays out.
I think we are all aligned that Palantir is definitely overvalued and overpriced. No one is making that argument here, unless you are like some engagement farmer and post that it's going to 1000x from here.
1000x, Amir.
Yeah, there are some people saying 1000x, regardless of what this like. It could be a $5 trillion company. It's gonna 1000x from here, But no, I think we're all aligned with that. We all recognize that Palantir is definitely overvalued and very expensive. No one's arguing that. But I would argue the sense of maturity to the business. I still believe it's early. That doesn't mean that it should deserve any kind of multiple, any kind of valuation. Just to clear that up. And if we go back to earnings expectations, Arnie mentioned average revenue per customer. What I think is important when doing this is to exclude the top 20 customers, because they account for 46% of all the revenue. I mean, we have 630 customers. 20 of those make up almost half. So I like to look at this where we exclude the top 20. And we can see something interesting here. So ever since we could start to track this, it's just been going down, 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 down. However, the past 2 quarters, we actually have increases in the average revenue per customers, which is another example of AIP actually starting to add more value and actually starting to be a cost for current existing customers, which is like a scale lever, as we like to say. So going into next quarter, I would really like to see this continue. I would really like to see Q4 have also an increased acceleration. Now, this chart, it doesn't look like there's a lot of movement because the base in the beginning period here is so high. But if we can incrementally just keep increasing the average revenue per customer as we keep scaling customers, of course, that's going to be very attractive. And that's one of my expectations going into Q4. If we bring the talk back to Q4 earnings preview, I think that's something I'm really looking forward to see and hope for.
Mm-hmm. Personally, I don't agree with it is necessarily overvalued. We can say that the prices are high. I personally don't have enough brain to forecast the future, because the only way to really say that at this stage is literally having a Palantir degree accuracy into predicting the future. And my simple bottom line is, as long as the story keeps improving and that is reflected in the financial numbers, I believe the multiples will just go up or stay very high, because that's a narrative that supports the story. Now, since we are in the market where people are willing to spend a lot of money for valuations, but companies are also willing to spend a lot of money for the products, I think we'll see some interesting times ahead. And in terms of valuation, well, this 100x potential is becoming very famous, even a meme. But I would argue Palantir has a 1000x potential, not 100. The point is, what is having a potential? I have a potential of becoming 10 times richer than Warren Buffett. You can't disagree with this sentence. I have the potential, but that doesn't mean it is reasonable to think it will get there. And on top of that, it is not really to think as reasonable into getting there in a reasonable time future. So the 100x potential is one of those sentences that you can't disagree with totally from a rational standpoint, because it's one of those sentences that are almost every time true. Like Apple has another next potential from here, even if it is already 1 trillion or 2 trillions, whatever. The potential means there is a probability, at least 1%, a tiny probability that we could go there. That is potential. Now, as you start having like limits into those sentences, you realize how that converges into the almost impossible to happen, especially is if you have a time frame that is not 200 years from now, because we are talking about 17 trillions in the future, and it can absolutely get there if we think of Palantir becoming the operating system for the entire Western world. Now, that means that Palantir has the potential, but as investors, we really need to think in terms of, okay, what is the reasonable potential of Palantir achieving the good results in 5-10 years from now? And already trying to have an intuition, I'm not talking about precise numbers, an intuition into where we're going into that 5 years is already something that is very hard, but very valuable, while dropping 100x potential here and there is pure engagement farming. You can't disagree that we all have 1000x potential of becoming billionaires in 15 years from now. But you see, if you start saying in 10 years from now, the probabilities already change. In 5 years from now, there are possibilities. Maybe Amit goes all in into the right call options and goes straight into the billionaire stage. But you see, as you start adding limits to that sentence becomes closer to false. While if you don't say anything, you just drop potential, is one of those sentences that could be potentially almost always be true.
Let me just say that I would be willing to pay a high multiple for Amit's potential to become a billionaire.
I think Amit's got he's got the best chance out of all of us.
I think so. Yeah. So speaking of narratives, one narrative that Palantir was plagued with was very high SPC, and I think unfortunately, together with the SARS, it will bring that up, and people who just look at Palantir at a glance, which is majority, I would say, of people you run into on X, for example, other YouTubers, stuff like that, people that don't track Palantir as closely as we do, they will see something like this, and the SPC narrative might be back, because, as we know, we have a pretty expected high SPC expense that will come from SARS. So my initial forecast for the fourth quarter, not counting SARS, was going down to 19% SPC as a percentage of revenue, which is actually quite good. I think when I made the comparison between like 10, 15 peers, at least what Wall Street uses, like we're talking ServiceNow, Salesforce, Datadog, companies like this, the average SBC as a percent of revenue was actually 22.5. Snowflake, C3, stuff like that. So Palantir was up there, but still below like the average. And I had them going down, hopefully below 20 for the fourth quarter, something like 19%. However, we do have the SARs to expense, which will not look great, both on an annualized basis, but also on a quarterly basis. So don't be fooled when people talk about, they just have a high SBC, they have no cash. Because if we go and actually, one thing we didn't touch on yet, I mean, we don't have to spend time on it, but we've talked about it a lot. If we look at, first, operating margins, as we can see, ever since they had their first profitable quarter, even though it was due to a sale of a subsidiary in Japan, they weren't operationally profitable until Q1 of 2023. And then it's been scaling up. And this is what Arnie mentioned earlier, that no one expected how quickly they could turn this profitable. Like, I'm talking operations, because the net income, a lot of that is padded with interest income from the yield farming that they're doing with their cash. But if we look at operating margins, I have that continuing to actually go higher, up to 17% for the quarter. And over time, over the years, I have them at something like 40% in 10 years from now. So I expect that to continue to scale, but we have this huge drop in net income, which is if we actually add EPS. We do have some SARs expensing to do. My net income expectations are higher than Wall Street. That's why this 2 cents looks a lot better than Wall Street's post SARs of like 0.003. Like, that's why we might see that 90% miss if Wall Street is correct. But yeah, I have them at 2 cents. Wall Street, I think consensus came down actually. So Wall Street consensus for EPS was 5 cents the last time we spoke about it. It's actually down to 3 now, I believe. So there have been some adjustment. Raymond James came out, we have to lower it because of SARs. I haven't read every single report that's out there, but it's likely that people are lowering their estimates, which could be good for the stock price implications. Like, they won't have that massive miss. It will still be a miss, but not as bad as we initially thought. So just quick comments on the EPS miss, and if you guys think it will affect the stock price at all.
Personally, I was expecting more analysts to wake up to these SARS arguments. I personally expected, or even hoped, there was more than 2 people out of the more than 20, probably 25 analysts covering the stock that have seen or the analyst reports or Palantir Weekly or some of our comments, because we have been, I think, quite pushing to trying to make people explain why this could be a risk, but why also this could be more a headline risk more than an actual risk. Because even if we consider, okay, let's say almost $1 billion vanishes from the cash the company has, that has some effect in terms of future net earnings margin, because we get less revenue from an interest income. Okay, that's fair, but with these cases, we should not make the mistake most value investors are more prone to do, that is focusing too much in the numbers without focusing on the context. And what is the context is what really matters is the operating story to keep improving. And as long as that keeps improving, we could start not only think in terms of the price to be sustained, but having also a sense of how the operations can keep improving from here. Now, we mentioned there is a very big headline risk into these earnings, especially because we are not in the 60 something as a couple of weeks ago. And the higher the valuation before going into earnings, the more vulnerable you are from that perspective. And if you combine that with like Palantir misses EPS because analysts didn't make a good job, that would be something that I would not complain with. It's just a risk that we need to be aware that could make the stock go down. Personally, I think for a short period of time. There was a comment from Brett on Twitter saying exactly that. Now, let me predict how earnings will go on Monday afternoon. 10K drops, banger. Okay, then people realize, oh, there are $120 million SARS expense that make the EPS drop. Boom. And then you have management actually explaining what was happening, and maybe people realize, okay, at the end of the day, that doesn't really care. What carries when dividends? Not joking. But you see, at this moment in time, we're not in a bear market where people obsessively search for is a 16 times margin while it was expected 17. We're now in the moment where the narrative is more important than the precise numbers. Now, all the algos are probably set to drop in case of a miss, but what really matters is how the management is able to convince the investors into this is not a story that is maturing, is a story that is keep improving and scaling. As long as they're able to share that, and I think with the latest interview, Karp made that very clear, we could be fine. And again, we are long-term investors. We could add, trim, or whatever, but if you are here, it's because we truly believe in the company going forward for that future. And again, as long as there are improvements, very strong improvements in the story and in the underlying economics, that could be only a short-term risk, only if you're short-term.
Yeah, I agree wholly with what you said, Arnie. I think as long as management's able to navigate that, and I think it'll just be showing up more maybe as an annoyance rather than a big problem. Annoyance being, I think a lot of people thought, not that share-based compensation was behind us, but these big spikes and massive amounts of 40, 50% revenue sort of ratios where you have 50% of your revenue basically being diluted by the share-based compensation. I think the only time it'll actually show up in a very powerful negative way is if by chance we underestimated the SBC/SAR expense /PSRUs, whatever they're called, all these different items that we're kind of sitting here with a huge backlog of expense kind of hitting a wall at this point. And if the EPS shows up negative, I think that's going to be a place where it's not going to show up favorably for management. It's not going to show up favorably, but I think we have sufficient ops margin, as Amir kind of showed on his graphic, that we should be able to eat it. But granted, it's one of those things where you really kind of have to shrug and put your arms in there and be like, I don't know what's going to show up. Is it going to be the 150 to 200 million that Amir is kind of having on his graphic, or is it going to be something that's diluted over the course of the next 2 to 3 years? I don't necessarily know how that's going to show up. And another piece, I think, though, is this will likely, like I stated, be an annoyance, not necessarily a thorn in anybody's side. But I think it's going to continue to be a topic of, what are we doing with this large cash balance of 4.8 billion, I anticipate by the end of this year. And, we've obviously stated that, okay, we're okay. We have $1 billion of potential buybacks that we can go and do, but we're only utilizing, I think it was like 5% of the ops cash that we actually get on a quarterly basis for the past 2 to 3 quarters to actually buy back any stock. What is the capital frame going forward, other than just continuing to stockpile cash? You're diluting shareholders. You have massive amounts of share-based compensation as part of your compensation package. I'm not saying that we need to fully offset that. Obviously, I think everyone's warranted to kind of get their share-based compensation. That's why we have some of the best engineers and other folks in the world that work for us, and that's why we're all invested in Palantir in general. But I think people are going to start to get, like I said, annoyed again that this is kind of a topic that's coming up, and we still have not really figured out an appropriate capital frame for the next decade. meaning how do we spend it, right? Capital expenditures, etc. We're going back and forth, and you have the Shield AI thing. Are we going back to what we did in 2021 with SPACs, which I actually was a fan of? Are you spending 10% there? Are you spending 10% on buybacks? What's the deal? Because this consistent contribution of cash to the balance sheet isn't necessarily the answer.
I mean, I think you're right. That's a huge question on a lot of people's mind, and I think even the interview on CNBC yesterday, I just caught it like quickly. I don't know the full context. Amit covered it, so maybe you can add it. But I recall he said we basically have infinite cash. Did he also comment in what context? Like what is he expected to spend that cash on? Did he mention that? I don't remember from the short part I heard.
It was kind of a comment in the context of growth. So he was like, we're only limited by America's capacity to adopt this type of innovative technologies in regards to AI. And then we're only limited based on the number of people that we have that would be willing to fulfill the demand coming from the US commercial business. And that's where he said we kind of had this unlimited money. Because basically he was trying to say it's not about the money. It's just about the ability to execute on the demand itself.
Yeah, so that's in line with what he has been saying, like historically, like we are not cash constrained. That's something he's been saying for 2 years now.
Yeah.
Arnie, did you want to say something? Sorry.
No, I just see Carp more focusing to making the right choices that could affect the company for a very long period of time, rather than trying to squeeze the most he can from the short-term opportunities that he could have. Like the short way would be, okay, let's spend all this money into marketing so that we can sustain the growth. But Carp seems to playing a different game. What kind of game Carp and the management are trying to play? Because that's what could give us a sense of are we making the right decisions into making this cash pile keep compounding or not. Personally, I believe they were playing the game of let's signal that we are a very serious company, that interest rates are high, so we know that is a tough environment, and we can just show that we keep accelerate while also expanding the margins, while also having a very strong cash pile. Essentially, we are a company that from an operating risk profile, we have almost no risk. And you are encouraged to become a partner of us, while alternatives are maybe weaker. They are not profitable. They are not able to find the right go-to-market. And that increases their reputation immensely. Because right now, Palantir can show by using our tools internally, and they have been quite open to share that they deploy Palantir internally very heavily, we are able to achieve these results. These are the results that you also want: accelerated growth, expanding your margins while printing a lot of cash. And which means having a ton of optionality if you want to go into one direction or the other. We need to think of cash as the optionality that we could have. Is like being an investor. The more cash you have, the more optionality you have to manage downturns. You don't have too much pressure into making short-term trades that give you $50. You're more, okay, let's make one step back. I don't need to rush into making a decision, but I need to be fresh into being able to spot where the market is really going. And meanwhile, I keep increasing my optionality, because there will be a day where this cash could be really useful, maybe to make an acquisition. Maybe it makes sense now, in this moment that we have the validation that the Palantir thesis is working. It makes sense to make investments in the sort of what I would have hoped Palantir would have done with Unreal. But there are some talks now that Palantir could be invested in partners like Shield AI, which is a defense company operating in, is a defense tech company for which Palantir seems to be in talk to invest in the capital. So this is something that when you have excess cash to grow while not sacrificing your growth, your expansion, could be very strategical, because it's not only a cash deployment, it's also a proof that your solutions work.
Mhm.
And personally, since these SaaS can have a direct impact on the cash, because we're talking about a cash expense here, the management per se didn't really expect the stock price to hit this hard by the SaaS were designed to be effective up to 2029, and we arrived there essentially 4 or 5 years before that. So that caught by the management by surprise. And as Emir noticed, okay, the newest SaaS are not based with the same limits. They are actually SaaS that require more vesting. So probably the management acknowledged that that would have been a better way to deploy the optionality of giving optionality to employees.
Mm-hmm. And before we move on to TCV, I agree with a lot of what you said, Arnie, and I 100% agree with you. I'm okay to be coached, right? These guys know way more about the business than I do. I'm just a bystander, but as all of us as investors, if you were to tell me we were only investing back into our business or buying or investing 5% of our cash that we get on an annual basis, I'd be pretty upset with you, right? So we're going to make about $1 billion in ops cash to the balance sheet in fiscal year 2024, of which we've only spent 40 some million dollars in buybacks, right? So I'm not saying, when I talk about an annoyance, I'm not talking about let's just go drop $1 billion here, $1 billion there, and I don't think you're perceiving it that way either. But my thought process is I would like to hear some capital frame metrics that they're looking for. Are they going to set aside 20 to 25% for investments like they are for Shield AI? And it might not necessarily be on a quarterly basis, but it might be on a rolling 12-month basis, or maybe rolling 24-month basis, that they're putting aside, however many billions of dollars in case of 24%, 25%, let's say. That would be close to $500 million every 2 years at the current run rate to be able to invest in something like that. And I think that's reasonable. And then same thing with buybacks in the future. We're a growing company that's very low capital expenditure. And so, like you stated, I'm not expecting them to just drop 2 billion, 3 billion out of that 5 billion or anything like that. But at the current run rate, at this time next year, we'll be at over $6 billion in terms of cash on hand without any sort of intervention. At what point, like you stated, I'm willing to be coached. I'm willing to understand where management's head is at. But, without that guidance, it's always going to be a question that people ask and bring up, especially myself, on a quarterly basis.
Sorry, Matt. Why do you think Apple got that insane cash pile before it started doing buybacks? I think you know that at a certain point, Carl Icahn, the activist, went in the board of Apple and started pushing, okay, you need to deploy this cash for buybacks because it makes no sense you're keep piling it. I think they reached something obscene like
I think Palantir is even in a more exacerbated situation, because if you were to say how much was Apple investing in terms of CapEx, I don't know the answer, but I'm just going to say it was probably roughly 20 to 30% of whatever they were making in the early days. Now it's probably less than that, 10, 15, maybe 20%. But I don't even think Palantir spends 5 to 10% in capital expenditures. So you literally now have 90 to 95% of all your capital that you're getting from an ops cash perspective going directly to the balance sheet. Mm-hmm. And I don't have that answer. I'll actually look at it. I'm kind of curious now that you're sort of mentioning it. But you talk about other companies like oil companies, et cetera, much more capital intensive. They have to have a much more stringent capital frame. But Palantir, because they have so little capital expenditure, they're such a huge gross margin business, they can literally not really have to worry about it at all. And I don't think people really blink an eye. But once you start to get to the point where you have literally more cash on we're basically getting to a point where we have 2 years worth of revenue in terms of a cash pile. That's pretty significant.
Mm-hmm.
I think this will be the last stat we focus on. So TCV, Amir.
Yeah, and not necessarily TCV, because we're talking about, okay, Palantir, it's all about the future. What tools do we have to gauge the future? What would give investors confidence? And I think this specific metric, it shows you how much worth of contracts they signed within the quarter. And as Arnie shared on his Substack and his newsletter, I think yesterday, Palantir signed a lot of deals in Q4. So I think we might even see a new all-time high for Q4 here. And that shows a lot of strength because this directly ties into first we have the deal breakdown that they like to show, like, okay, how many deals did we close? What is the size of the various deals? Like they break it down to 1 to 5 million, 5 to 10, and above 10. That's all comprised of the total contract value, which then is broken down into remaining deal value and stuff like that. Like that's outstanding for Palantir to come and collect with options. But this specifically, I think, will be very important. I know not a lot of people care about total contract value, but I do, because it shows us the contract activity, and we need that to accelerate. As you can see, like our all-time high is in 2022. Not even after AIP, after boot camps, are we signing like a lot of contract value. So I think this needs to accelerate, and I believe, given like all the news we have from Q4, like the Maven, like Arnie compiled a whole list that is sent out to his Substack, I believe, Palantir Bullets. I think we will see something very strong for Q4 that will directly translate into, okay, we know how much contract value we have signed, and those contracts can be anything from 1 to 5 years. So it's not, while it doesn't show up in revenues immediately, it shows us how much of a backlog of revenues there are to collect over time, which is very important when we're talking about a company like Palantir, that we say, well, it's all about the future. Well, how is that stacking up into the future? So I believe we will hit an all-time high. Like when we're talking Q4 earnings expectations and previews, I think this metric is one that I'm really looking to see a new all-time high in total contract value, and that will signal a lot of confidence in future revenue generation. That I don't see a lot of people talk about, but I think this one is actually turning out to be quite important for this quarter.
Emir, if we look at this chart, it seems a little bit disappointing. Let's say that we see this chart without knowing that revenues are actually expanding, everything is going well. If we look at this chart as a standalone basis, that is not really aligned with the story that we know is happening, that more and more clients are adopting Palantir and the existing ones are very happy to expand. What do you think there's the case of that chart not being that strong in a total contract value contracted?
It actually is very strong. I mean, this is on a quarterly basis. I mean, the run rate per year for 2023 was like 2.23 billion. But just on the trailing 4 quarters here, we've signed like almost 4 billion of total contract value. So it's like the run rate, like it doesn't look like just straight to the moon. I guess that's what you're talking about. But if you actually look at the total contract value that they've signed, it's way ahead of revenues. And I expect this to actually start to accelerate now, especially considering it's no longer like people don't shy away from saying, yeah, we work with Palantir. Like a few years ago, like people asked Palantir not to disclose that they were partners, that they were paying Palantir. It was a black box, bad media narrative. Now it's changing. Now people want, like, they are lining up to use Palantir. So that's why I think this will start to increase, but I don't think it looks weak at all if you just look at the actual numbers and compare it to revenues. I mean, there's a lot of revenue expectations built in, like even on a trailing 12 months basis. I think this is really strong, but I'm expecting it to be even stronger. And that's what I mean when I say this really signals what kind of revenue growth we can start to expect from Palantir into the future, because they will likely start to sign a lot of big deals. We know, like, just the Maven contract was like $500 million in Q4, right? And that just starts to stack up. That's why I believe we have a lot of revenue generation to be had, and we can get a preview of that by looking at how much contract value they sign per quarter.
Okay, absolutely agree. Personally, I asked that question because if you ask me, okay, what kind of total deal value do you think is happening right now, considering all the information that we have, I think I would have expected a chart that was more aligned with the revenue growth, like spiking up much more. And I was surprised to see that yes, improving. I personally expected something more, and I was wondering why. Now, just a little. Can you share the screen, please, just to show that this is the deal activity that happened in the last quarter, and we can see it was pretty intense. Especially the big one was this $600 million contract for years with the Army, essentially an expansion of the existing platform on top of which Palantir has been already working for a long time. So now it's not that we can literally take a 600 divided by 4 because there are some like overlapping in terms of contracts. This is maybe the total value of the potential value of the contract, but we need to consider it as a signal. Okay, the Army is really willing to spend big money into something, and the more money it spends into something, the more they will keep spending on top of that. So that's important to underscore. And you can see that there are many partners that are emerging partners, like Anduril. Like this one is very big. Then we have Shield AI partnering to deploy warp speed, and we are seeing the narrative shift towards also not only AAP but warp speed. Also in the new video that Palantir shared just yesterday or 2 days ago with Hyundai, where they underscored that we are using Palantir from the design, from the production, to literally everything, which was, oh, this sounds very warp speed. And I think we will keep seeing these playing around. And this quarter deal activity compares with the Q3. So we see fewer, like less activity, and with last year. Like we had very good deals, but just visually you could see there was much more activity this quarter. These are press releases. Now people are even complaining that, oh, we are not getting too many press releases in January, but because in December, like in the Q4, we got literally so many. One dynamic that I would put the attention on, if we think of that chart that you showed, almost like growing, but growing steadily rather than exponentially. One potential reason could be the shift from having big contracts into pushing more into consumption. Because if you push more into consumption, you don't strike a $50 million deal. You strike a deal that is smaller in nature, but the more you consume, the more you spend. And these contracts tend to be different in structure. Like the normal subscription is, okay, you sign 50, and then the more you go into the contract, you recognize that 50 divided by the period. With consumption pricing, the counting is very different. So probably you start with a smaller account, a smaller total deal value at the beginning, but you just see the revenues expanding because if customers just use Palantir more, they spend more. And that's why I think it is very important to put the attention. Like we know we need to focus into revenues and so on. But what really matters is are existing customers so happy to use Palantir more? Because if that is the answer, we will just get a lot more revenues just from happy customers. If you are happy, you consume more. That's simple as that.
Yeah, that's a great point. And what you just said also explains why our all-time high was actually in 2022 and not a recent period. Because at that time, typically you would sign like the contract might be for like 5 years, but it was like big. So that's why it really added up. Now there might be a lot shorter time frames and a lot smaller, just like as you mentioned, to scale up from a smaller point and going up because they switched to a consumption-based model. So that explanation makes a lot of sense. And as we mentioned, yeah, the scale up of their current customer base is what really matters. As we talked about before, the net dollar retention, the customer count growth, and stuff like that.
All right. I think we end it there. We actually have something fun to end on. First of all, let me just read the super chat by Nunzio. Thank you for the $20 super chat. Thank you for staying up late to do the show. P.S. I hope you watch Billy Madison this weekend. I hope I get time to watch that movie this weekend as well.
It's literally one of my favorites, Amit. You got to do it.
Yeah, I'm supposed to watch it like 2 weeks ago, and
It's all right.
I have not watched it yet.
How is
But,
your movie culture course improving?
Dude, I fell asleep to a podcast about the Soviet Union a couple days ago over a movie. That's how bad it is. I can't focus on the movies. I don't know. I just can't focus on the movies. But I can focus on anything else.
Like I'm kind of curious now. What was the Soviet Union podcast about?
It was about the Soviet Union. And then I had a dream, and I didn't tell the story in the market open, but I had a dream. I was in Russia, and it was like they wouldn't let
Russian
me go to
meetup.
Dude, no, they wouldn't let me go to the bathroom by myself. Like it was like literal communism. Like it was just dictatorship, and like someone had to follow me into the bathroom because they thought I was gonna like escape or something. It was a crazy dream, bro. Insane dream. But the point is, I fall asleep to these types of podcasts versus watching movies. That's the issue.
You're like, this new generation is so cooked. Like one of the greatest trilogies ever made that will go down in history, Lord of the Rings. Like he covers this stock every day. He can't even watch Lord of the Rings. This generation is cooked. I mean, I don't know what to
I remember going to the theaters at midnight to go see Lord of the Rings, and it was just epic. Like,
dude, who goes to the theaters anymore? Is that a thing?
That was back in the day.
Well, it was a different experience. Like Lord of the Rings, Harry Potter. Like if you look at it from the eyes of a younger generation, they're just okay. But for our generation, they were like completely out of the league compared with all the other things that were out there. So that's why we deeply care about them.
But we didn't have Netflix. We didn't have like HBO Max and
but even with Netflix and HBO Max, dude, I'd rather choose to like listen to a podcast about the Soviet Union as I fall asleep versus turn on a Netflix show. It's weird, bro. It's very weird. I don't know how my brain works, but it is what it is. This is how we end the show here. Elon did tweet about Alex Karp. So Sarah Eisen, who is the CNBC host that posted about him today, did quote Alex when he said, "The two CEOs that went to Israel who run publicly traded companies are Elon and I. Whatever you think of Elon calling him a Nazi, especially since it seems to be highly correlated to having been supportive of essentially the Hamas wing of the terrorist movement in some ways, completely absurd and like a complete rewrite of history." Karp was defending Elon against a lot of the hate he's been getting over the past week. Elon responded, "Alex Karp is awesome," which is nice to see. He's been sharing a lot more of Karp's posts and reposting his videos and Palantir content in general. These guys are relatively friendly with each other. And so it's cool to see both of them in the limelight as two of the most important tech CEOs on the planet right now.
Look how cute they are.
So cute.
It seems Elon Musk is literally on like being happy to be associated with Palantir now.
Yes. Yes.
Because look, this is not really something that happens frequently, at least as far as I follow Twitter. Still Twitter, not X. But can you share the screen? Like even a couple of days ago, he shared this. Like he reacted to the official post of the Palantir account of Shamsankar explaining why reforms on the DoD are truly, truly needed to make America staying strong. And true, like, okay, simple sentence, but we see signs that Elon is happy to be in that constellation of people. Obviously, the fact that there is also David Sachs, all these people in the constellation of the government helps, but at least from the shareholder standpoint, I'm happy to see Palantir is aligned to this new administration, even if Karp was not fully supportive from his personal political view. I think that is very important to see, seeing that the values of a company are more important to people around the government than the actual political belief of Palantir CEO alone.
All right. Awesome stuff. All four of us will be live starting 3:30 p.m. Eastern Standard Time on Monday for Palantir's Q4 earnings and whatever happens to the stock, if it goes up, if it goes down. we will be here to cover it as a community, as we've been for the past couple of years and as we will be going forward into the future. That's it. Thank you, everybody.
Thank you so much,
Enjoy.
everyone.
We'll see you guys next week.
Good discussion, all four of us.
Thank you. Good night.
Bye, everybody.
Good night.
Good night.